Welcome to the Gray Report. I'm your host, Spencer Gray, and today we are going to be talking about opportunities in real estate for investing in multifamily apartments. So some of the themes we're going to be talking about the stabilization that's going on inside the multifamily market as we're seeing strong demand, but in the face of really heavy historical amounts of new supply. But we're also going to be getting into some of the complexities of this housing data, looking at different sources, what, not just the methodologies, but just the different ways to kind of slice it and look at all of the new high frequency data that we're getting every single day. And then, inflation dynamics and related to housing costs. How does it all make sense? And what are the intersections of all of these three themes? And to kind of get into that, we're going to first look at the apartment list report for June 2024, looking at some of rent growth trends, vacancy trends, getting into a little bit of new supply. Then from Colliers, getting into their capital markets report in their 2024 multifamily outlook. From the National Association of Home Builders, we're going to be getting into this article called Considering Housing Inventory, Why Both New and Existing Supply Matters. And then lastly, from Marcus and Millichap, Getting Ahead of the Fed, Why Inflation Isn't as High as People Think, and then some other pieces kind of in between, and of course some original opinions from myself as well as Matt Bosnagel. Everybody, welcome back to the Gray Report. Joined again by producer, director of communications and marketing here at Gray Capital.
Hello,
Matt Bosnagel. How you doing, Matt?
Pretty good. This was an interesting week.
Full slate.
And it's like the report kind of wrote itself this week.
It did,
for better or worse.
It did. Well, because I took some of your notes and then I put in ChatGPT, so it did write itself. I got the whole thing. Yeah. It wrote itself.
The robot wasn't so evil this time.
No,
so.
although now I have more notes. So it actually did.
I know that's what I was noting.
It didn't help because I asked multiple different ways, and then I printed them all out, and then I don't even know what to go on. So anyway, so we've got our notes. But first, Matt, let's get into talking about this apartment list report, because that's kind of some real-time data, kind of where we are, state of the market. And the theme is, we're in the process of normalization.
Yeah.
Certainly we're not normal right now. We're still reverting to the mean a little bit, because what's different right now than you would typically see in a normal rental market, normal season, is that we would be seeing stronger rent growth right now. Typically, we see most of the rent growth for the year kind of in this June, July, August time frame, kind of plus or minus a month. Kind of every given year, it's within that range though. Kind of starting mid-April, starting to ramp up in March, and then typically by August, things are slowing down, and certainly by September, things have slowed down. And we'll just pull up the report, because then after September, you're typically starting to see a slowdown, and then by November, it's almost nothing, and then December is typically zero or negative. Those winter months, usually you typically see a little bit of declines, but normally,
if you're looking for rent growth, you can't sugarcoat this.
Yeah, no, it's just there's normal seasonal patterns that make sense, and COVID disrupted some of those, and that's what we're getting back to it. But again, you see the starting in the second half of 22, we saw negative growth earlier than we typically would have seen. In prior years, we only have 1 year that's kind of pre-pandemic, but we had a negative couple of months, just prior. But not usually the negative growth months are much more subdued than the growth. So you'd see a lot of growth during the summer, and then a little bit of retraction and sort of reversion in the latter half of the year, kind of that last quarter or so. And then you see 2020, everything got messed up. It's almost nothing to really read on. And 2021, though, that's when things got crazy. Everyone realized how much a demand for housing and occupancies were up, and household formation and stimulus checks, et cetera, skyrocketed up. And then we only had 1 month of negative growth, but you could see the seasonality still peeking its head in, saying, all right, look, December's still going to be a slow month, guys, because no one wants to move around Christmas. Like it's just that is what it is. And then the first half of 2022, a strong surge, but then we had an unusually strong negative environment really in the latter half of 2022. And then it has just been kind of milquetoast tepid growth since. Starting in 2023, we saw a lot of inflationary pressures, but this is also when the supply really started coming online. A lot of the permits were issued in 21 and 22. I mean, who wouldn't have, tried to build some apartments in 2021? You saw rent growth was 15%, interest rates were 0. And so we had record numbers of, building permits for multifamily starts being issued during this period. And then, they all started being delivered all in an environment where all of a sudden rent growth was slowing down, which is obviously is causing some problems and concerns in the multifamily industry for some of those projects. But now, as we're in through 2023 and now 2024, 2024 is seeing similar tepid growth that we saw back in 2023. Now, rents rose 0.4% in June, which is good. But so far, rents year over year, Matt, they're down what is it 0.7? Yeah, 0.7% year over year. So, good news for renters, not great for landlords.
Yeah.
But it begs a lot of questions of what will the rest of the year look like? Because we will most likely, I can't imagine again, Matt. We're going to see a slowdown after August. We're going to see some negative rent growth.
So if you're looking at these numbers, and I was staring at this, it looks exactly the same as 2023, except for 2 months ago, rent growth, month over month rent growth in 2024 was 0.1% lower than the similar period for 2023. So essentially, it is exactly the same as 2023, only the January number was slightly improved. And let's say, I think it was the May number was slightly lower. So it's basically a wash if you take those and, but so we could, what I think though, is all of the signs that I'm getting from, supply and the reports and construction and all that kind of stuff, it suggests that the supply wave has crested and that the new supply coming online is going to get lower and lower. So we may see it could be negative rent growth this winter, but it could be a little bit less negative than it was in 2023.
That's exactly my prediction would be as well. I don't think we're going to see as much negative growth in the winter months, but I think that it certainly will be negative, and we're going to probably have some overall negative growth for the year. What's challenging, but it creates a great opportunity for buyers right now because the reality is prices are low. Prices are off 20 to 30%. Growth is slow.
Yeah.
When growth picks up in a year, 2 years, the prices most likely will not be as low.
Oh yeah.
Because cap rates are high right now. Prices are suppressed. The growth is slow. But if you wait to buy when the growth exists and you can read a report and saying rent growth is strong, it will still probably be a good time to buy, but it won't be as good because you're going to have to pay probably 10 or 15% more or more than what you are paying right now. And so investors are having to come to a decision of, do I buy low, get the good basis now, to wait for the growth. And the risk is, what if the growth doesn't come? You have to be comfortable with what the deal will produce at slower growth numbers and kind of where it is today. And that's why you need to buy with positive leverage and in good basis, smart financing. So we're seeing opportunities percolate up. Yeah. But there's not a lot of inventory in the market, which is challenging. But again, investors, they have to say, all right, maybe buying when it looks a little bit scary or uncertain is the time to get in. Because if you listen to economists right now, the one thing, again, I was listening to Bloomberg on the way in, and I've heard this every single day, and it aligns with kind of what our base case is that they're very skeptical of owner's equivalent of rent. That is a component of CPI receding too much, because in their mind they see really no scenario where how rents can't grow at a moderate, if not strong rate. Because even despite all the new inventory, we still have a major deficit for housing in the United States.
Yeah.
Again, depending on who you ask, there's between 4 and 7 million housing units that we still need to build. We have household formation, which is really kind of driving up right now. And so you have to look at that fundamental data and saying there's still a major supply and demand imbalance, which is reasonable to assume we'll see above trend rent growth. But you have to go in and buy low to be able to take advantage of that to get really strong returns. And so you do have to kind of take a leap of faith. But if you can do it in a way where you say, okay, if that doesn't happen, I'm okay with the result. But there's a chance for upside. I'm going to limit my downside because I'm buying low, financing it right, with a lot of chance for upside, which I think is exciting. But it's not just so clear and so obvious. And because again, if it was, everyone would do it.
I think that it's interesting. It is, the idea is like definitely catching on. I think we'll get to some opinions where it's like kind of a carried an assumption that this is an interesting opportunity and it's an attractive opportunity for a lot of investors. We're comparing the snapshot of now to what we think the future is going to be, and it's not just a speculation about the future. This is based on a lot of housing construction data, whether it starts, permits, even like it's speculations kind of about the interest rate. It is things that we kind of understand where things are going and what caused them. And so, sure, it's a guess, but it's as informed of a guess as you can make, and it's a guess that a lot of people are making right now. So I think that it may not be a foregone. It may not come up in the cocktail party, but among a lot of industry insiders, I think
on what
that see where it's going
to.
Yeah, that's right. But year over year, down 0.7%. That doesn't look great. Month over month rent growth at 0.4%. It doesn't look great. But we'll cover in a second here how much record breaking absorption there is. How much, and this is something that's worth noting actually in the apartment list report itself, is vacancy. Vacancy really looks like it's flattening after a very long period of gradual increases, and that really stretched back to October 2021 when it was a low of 3.8. It is at 6.7% right now, so a little more than 3% above where it was at its lowest, and it does not look like it's headed up anymore. If anything, you see a gradual hill. We are at the crest of this hill in terms of vacancy, and it could be headed down. There's all these signs that it's headed down, and the reason why is you've got this backdrop of housing demand up against declining but still elevated new deliveries. So as those deliveries decline, my assumption is occupancy would start to rise, vacancy would start to go down. And other sources like RealPage, and then there was a report in NAR. Now I'm not sure if they're taking RealPage data, but still, there are a couple people are saying, hey, look, occupancy is actually positive after 2.5 years. So a lot of strong signs.
Well, and it's also relative. We've talked about this before, Matt, is that we basically reverted back down to pre-pandemic vacancy levels. But despite or in the face of record deliveries, where most people, if you just went to an economist or somebody in the housing market, pre-pandemic, and you said, okay, hey, we're going to deliver 700 to 900,000 apartment units in a single year in a market where rent growth has been tepid, and what's that going to do?
Exactly. Yeah.
And you'd say, well, vacancy would spike and you'd get occupancy down to 90%. It's going to be in the mid 80s in a lot of places. And certainly you'd see rent growth be highly negative, but we're not seeing that. We're seeing vacancy come off the highs, revert to kind of like the average, revert to the mean. And we're seeing rent growth being, flat, slightly negative, or over the whole nation, but like less than 1% negative.
And that's where you get a safer, more justified projection of what the future is going to be versus the snapshot. Snapshot doesn't look good. The future looks good because we know what drives the snapshot. We know what's unusual. So what's driving low rent growth is high deliveries. And if you look, what are deliveries going to be like in a year from now and maybe a year and a half from now? They're going to be lower. And then, what drives demand? Well, household formation, job growth. We're seeing relatively high numbers of that, very healthy right there in terms of job growth or household formation. Now it's household formation that's really and Carl Whitaker notes this in a recent post that you've really that's going great. I think that there is some pent up maybe housing demand that's still left to be unlocked.
And surprisingly, not that affordability is always going to be a challenge and a point of conversation, but less conversations about affordability. It seems like, we're seeing a lot of wage growth, and delinquency, anecdotally, that we're seeing is actually improving. Occupancy is improving a lot of our properties. Again, that's just an anecdote and snapshot of Midwestern markets. But I bring affordability up as that would be the other, the speed bump to be able to achieve any other rent growth. Which is like, look, inflation, people can't pay any more rent. Like it's not possible. But we're not seeing really running into that nearly as much as we may have thought a couple of years ago, because wages are significantly outpacing rent growth. And again, that cost of buying a home and a mortgage is just unobtainable to even more folks. But that's really talking about a higher income spectrum rather than the folks that are more kind of that lower quartile or so that are having a little bit more struggles right now. I want to move over to this Collier's piece or anything else on the apartment list.
No, only to say that this is in a brief. That was a really good a teaser, I think, for a fuller discussion with Apartment List's Chris Salviati, who's coming on to the Gray Report later today for us. But I'm gonna release that episode maybe a little sooner.
Yeah, so I'm going to be going into a lot of detail with Chris on that report and some other articles that he's published over in the recent past. A lot of it has to do with supply. So we're going to be taking a deep dive into kind of apartment fundamentals, deliveries, construction, vacancy. So really kind of getting into what they see and also how they put the reports together at Apartment List, because they do a great job. We cover obviously the Apartment List reports at a pretty high frequency because the quality of the data, the frequency of the data, and also I'd say their relative transparency on their methodology. I mean, they have a whole methodology section. They're explaining what they do, how they do it. Whereas some other sources, there's really no kind of methodology.
And I also like Apartment List because out of the major releasers of this rent growth data, whether it's RealPage, Yardi Matrix, or really like NAR or something, Apartment List has a perspective that's a little less tied to like the investor mindset. RealPage is very much in it, and I think so is Yardi Matrix. But Apartment List, it acknowledges like, okay, it's bad for renters if rent's high. They actually quoted how rent's low now, but it's still 23% higher than it was at the start of 2021.
Yeah, that's a great point.
Usually RealPage doesn't have that caveat, but Apartment List puts that in there because there's a lot of renters that'll read this too, and they're kind of representing that perspective and giving that information to their audience.
No, that's a really good point. So Matt, we're going to queue up this U.S. Capital Markets report from Colliers for their 2024 market outlook. Bring us in. And,
all right,
what do we think?
This report, I think either directly or indirectly, I think maybe more directly than I thought at first, it really highlights the magnitude of the current opportunity of the investment market. Yes, certainly the United States economy could crash, and currently decelerating price growth could slip into stagflation, maybe, or we could have this recession that could happen, and we'll get into this with John Chang's video on soft landings and stuff. Well, but just looking, if you were to put that on one side, if you were just at the trends of both apartment supply and apartment sales, this starts to look like a really tempting moment to strike. There is a CRE analyst post recently that says basically the smaller, overexcited investors who bought at too high prices can't take advantage of the current market now, and that may be true. It is. I'm not sure if it's true for all smaller investors. I just think that the people that were careful, I guess, and didn't buy at too high prices, whether they're big or they're small, the people who were careful are going to reap the benefits. And the assumption here is that things are going great in terms of like the opportunity that we can find, and it's up to these people that are well capitalized to take advantage of that. But
it makes sense. I mean, because if you overpaid and you are maybe facing maybe a capital call, or your investors are facing capital calls. I mean, you are in you're salvaging, you're in an emergency mode. You're saving your current deals, and you're going to your investor base and saying, hey, I'm going to need you to double down on this deal that isn't really working out. you don't really have the bandwidth to say I'm going to go out and buy another deal, and I've screwed up these couple deals.
Yeah.
Give me more money. It just doesn't work.
Yeah.
Whereas, REITs, which have, much more opportunistic, they weren't as, they bought plenty during the same period also, but they're capitalized in a different way where they can manage their debt and the risk associated with their debt much more efficiently. They can swap out different facilities with a lot more ease and flexibility as smaller borrowers. And also, they've got a portfolio of 100 plus assets. So if a couple don't work out, their whole business model isn't at jeopardy. I mean, we bought a deal from a REIT, Matt, that they sold to us at a big loss, but it ended up being a win for them because they got to recycle that capital, buy something else, and then it reduced their overall their debt load. And so they were able to actually go out and raise more money because they were able to get essentially a better credit rating because they had less debt. And so they're just operating at it. They're playing a little bit different game, different strategy, and a different set of rules of what investors are going to expect. Yeah. And so now, in the context of more the middle market groups, a company like Gray Capital or other syndicators, especially some of the newer, smaller syndicators out there who have maybe all of their portfolio or a large portion of their portfolio was acquired during 2021, where they don't have any more powder. Their powder is wet or it's spent. Their casings are spent. They don't have they aren't positioned to go out there and make acquisitions. And even if maybe they could, I think this is also a big part of it. Is they're uncertain about the equity raise. It's not easy to raise capital right now.
That was kind of the point of the CRE analysts. They are put themselves in that position because they increase the uncertainty if they remain so active while the market was at its peak. Yeah. But to your point about striking when the iron's hot, and you were talking about this last week is. The inverse of consumer sentiment may be the sign of how much the opportunity is. So when people are thinking maybe this is oh man, we're in the doldrums, we're in the dark ages, that's when you can get in more or less at the bottom, and that's more or less kind of what's happening in the CRE market. In this Colliers report, the amount of people buying and selling multifamily properties right now is strikingly low, and it's been that low for about a year. And it is if you look at the graph they have on there, you can see all right, no one's trading right now. It doesn't look like it's great, but it also could illustrate there's a really big opportunity. And if you didn't look at all the other signs that we have that show us that fundamentals project something strong in the future, you could see that maybe it wouldn't be an opportunity. If it was a recession, then there's low sales. That's bad. But,
and if there weren't fundamentals that were driving it, billions of dollars would not have just been invested by Blackstone and KKR. I mean, and we haven't, I don't even know, fully covered the KKR acquisition but they're buying $2.1 billion of multifamily assets right now. I think it was announced last week. And again, it's another data point. And about a month prior to that, Blackstone came out and said they were making a massive portfolio acquisition. I want to say around $8 billion or so. And so that we've been waiting for price discovery and market activity. In both of these transactions, the cap rates are probably going to be, we don't know, and there's different ways to look at it, but they're going to be in the low fives. Maybe some in the high fours, some mid fives. But it's a lot of data. And I mean, Blackstone, they are playing a different set of rules also, and they can be opportunistic and they can be a little patient, but they are going all in. I mean, if you read any of their market commentary and their analysis, they are going all in on multifamily right now.
And just to repeat myself, that's the assumption in the CRE analyst post. They didn't even have to say it's a great opportunity. They're speaking to an audience that's perhaps just as smart as the Gray Report audience. So exactly, that's what I meant. So they know that these fundamentals are improving, that there is an opportunity here, and it's so clear to them and their audience they don't even need to say it. Now, again, people like Carl Whitaker will say, and I'm just going to add this quote specifically, Carl Whitaker says, there's something potentially remarkable brewing in the U.S. apartment market right now, and it's all about demand. Data for second quarter 2024 shows that renter appetite is not only strong, but arguably downright impressive. They're talking about absorption for the quarter that is off the charts, and they and so remarkably rosy picture.
It's almost. I mean, you have to go. It's beating kind of pre-pandemic levels. I mean, you have to kind of really go back. I mean, maybe at one point back in 2018, Matt. For like a month. But I mean, again, you have to go back to 2021 to find a data point that really beats it.
Yeah,
that is impressive.
So, and there's also this report I referenced from NAR showing absorption up 2.5 times compared to a year ago, and vacancy that has decreased for the first time since Q3 2021. There is a lot of collection. It's not just one source that is saying this. This is corroborated by multiple sources. And finally, just to kind of put a pin in this, Colliers themselves gives a succinct and compelling answer to why is this an opportunity. They say today's buyers are able to acquire assets at a reset basis, which is regularly below replacement costs. Fundamentals will begin to improve, setting the stage for more robust NOI growth if OPEX can be controlled. That sounds very nerdy, but it's essentially the same thing that Carl Whitaker kind of alluded to. The opportunity is huge. There is something potentially remarkable brewing in the U.S. apartment market right now. And so there's also a paragraph here about loan maturities. They haven't gone away, and in this environment with low sales, where people are potentially holding on until cap rates compress again, it is loan maturities that may be driving a lot of these opportunities and creating maybe a situation where people are feeling the pressures of the moment. The pressures of the moment haven't gone away. It's expensive to operate apartments still, compared to the norm. Price increases have not gone away, unfortunately, for things like insurance for operators. Rent growth is not great. Occupancy may be improving, but again, we're talking about the future. The now is what's pressuring people that may be facing a loan maturity, and that's not going to go away. And also, we referenced this last week, but banks themselves are starting to get, I don't want to say they're getting sick of holding CRE loans, but they are getting less happy about holding them. And
we're almost at the emperor, we're at emperor is wearing no clothes, situations of where the banks are saying, hey guys, I'm sorry, but like this we gave you time. We haven't seen rates come down, we haven't turned the property around, and our shareholders are saying, where's the money?
And
show me the money.
And it may not matter so much about, hey, look at this vacancy, look at where the trends are going to go next year. It's like, I don't care about that.
We're
I don't care about right now.
Because the last year and a half has been like, we'll give you some time. Like the time that was given has expired. So, and sometimes more than once. And so I think lenders are starting to get at that point where, you kind of have to, you got to make a decision. You got to get moving because they got to get it off their books. They want to, reset their basis as well.
Yeah. So and I just wanted to note that too. It said loan maturities are here. Well, they were here when we studied them. We put out a whole research report last year. They're taking a long time to arrive. This may be kind of attenuated over a longer period of time, but they're not going away. And there's a good argument to say that it's going to result in some opportunities for investors.
Makes sense. All right, now moving on, Matt, to more about construction and deliveries. On housing from the National Association of Home Builders. A lot of great data points and graphs in this piece. You want to just bring us in there?
This is just it's an interesting article about the single-family home market and construction. Some of the data on housing construction is not as precise as I would like, but I think it paints a picture of just how unusual the market is right now. For instance, they're talking about the difference between the sales trends for newly built homes compared to the sales trends for existing homes. This gap between the two, with existing homes far underneath the sales of new homes, that gap has never been bigger. And the reason why that matters is, from a certain point of view, you might be tricked into believing that we're kind of building too many homes, which is a little bit funny for me to say because...
Well, I mean, anecdotally, you might think that. I mean, I drive around maybe like I'll drive around the suburbs. I'm like, damn, we're building a lot of houses right now.
Yeah.
Like, are we sure we're good on this, boys?
Yeah, exactly. And so they also bring up like a couple of rules of thumb. So the way that they are calculating the inventory here is they take how many months would it take to go through this supply that we have right now. And for newly built homes, the sweet spot is to have 5 to 6 months of supply under construction. So under current trends, it would take 5 to 6 months to get it all sold. Right now, that number is 9.3 months. That's way higher than the sweet spot of 5.6 months. And the reason why that number is so big is, partly is because they actually include in that number for newly built homes, they include homes that are beginning to being built, in the process of being built, and just finished being built.
So you think this is a reflection of just the amount of construction that is going on, but some of those have been like maybe pre-sold?
Yeah, partly, but I also think that the way stronger thing is it's an interest rate thing. So that lumped inness, that tracks all the way back to when they started making the figures. But the real important thing is is what we know is happening right now. You can't get an existing home anymore because people are holding on to their low rates they got in 2017 or whatever. And so
21.
And so instead, I can't get. No one's moving out. Got to buy a new one.
It's so true. I mean, the inventory of homes that exist, there's not much out there, and then you got to put more money into it, and then especially with the advantages of some of the home builders, the big guys, is that they have incentives on financing. They'll essentially self-finance or provide special terms to home buyers and say, we'll give you a teaser, we'll give you this awesome rate, we'll let you borrow at 4%, and then you go out and buy an existing home. You're just going to a bank and they're like, you're going to pay 7%. And so they're greasing the wheels, subsidizing the sales by giving preferred financing terms to make it easier. And then also it's like, okay, the existing home, I got to go put money into it, and it's older. Versus getting exactly what you want. And I mean, again, north side of Indianapolis, there's a lot of subdivisions being built right now.
Now, it's important to note that new homes. So the graph that we're showing here is more really an accurate reflection of the trend line of where the balance is, because the actual balance is existing homes outsell newly built homes 10-1. But
just because there's more of them.
Yeah, because there's more of them. But and that's how come. So the inventory for existing homes is only 3.6 months, but instead of it drags that 9.3 down to 4. So the absolute number then is 4.4 months. So you got this whole lumped in thing. You got the size. The rule of thumb is they have these scatter plots in, and they show. All right. At what point? How many months of inventory do home values start to begin to go negative? So if you have more than 8, and they have a scatter plot here. It's never the same. There's a correlation.
6 months, some will, but then after 8 months, people are like, all right, we got to get this thing moving.
Exactly. That's when things cross over the threshold. If more than 8 months,
9 months, everyone gets really desperate.
Yeah, exactly. Well, and that's why that's what makes now such an outlier. It's because it's such an unusual part. It's such an unusual market here. It is, and this is my favorite. my favorite quote is, "The data thus show that current market conditions are unusual." I'd say so.
Thanks for that. But Matt, I mean, really, you are right. I mean, like the median is really the bulk of the home sales are going on at this around 4 month range. That's where like the major cluster is, and in those homes, which are probably the homes that are priced in the, call it, I want to say $300,000. But there's not many homes for $300,000. $300,000 to $600,000, I think, is that sweet spot, kind of a starter home, maybe a little bit more, plus or minus. But those are going so quick, and I mean those are really kind of going probably 2 months. But then if you got something big, it's old. Maybe that's the stuff that's really kind of hanging out there.
And they have a similar correlation, although it's not as strong for newly built homes. That number, instead of 8 months of supply, it's 6 months of total supply. But they also note that home building is a function of demand side housing factors like interest rates, as well as volatile supply side variables like cost and availability of labor, lots, lending, lumber, legal, regulatory fees. It's a little fuzzier, but the correlation's still there. After 6 months, maybe the prices of homes start start to dip down instead of going up.
So if you are in the market for buying a new home and you want a deal, look for homes that have been on the market more than 6 months.
Oh, yeah.
Or maybe even more than 4 months. But
Yeah.
after 4 months, that's when people start questioning.
Yeah. So that's this interesting relationship between the inventory and housing demand, and really the full upshot of this whole thing is this environment, this unusual environment. A crucial part of it is consistent housing demand. If housing demand was any lower, we wouldn't see people fleeing existing homes and building their own homes. Everything would just be going down.
I mean, Matt, everybody said there was going to be a housing crash. I mean, myself, it didn't make sense.
They're still
that if
saying
you're gonna,
it, by the way.
Yeah, well, broken clock,
Yeah.
right twice a day. But I mean, if you have interest rates move up the way they have, you would think that you would break the back of the housing market.
Yeah,
I mean, that's what's happened. But it's just, again, the only answer to why not is because there's so much demand out there, and it's buoying up the market, and the consumer isn't in as bad of a shape as I think that most would believe.
Yeah.
I mean, not that everyone's doing great, but it's not like everybody is absolutely kind of in the pits.
And I wonder if that is what, Jerome Powell, regularly has to remind people that he is scary and he's still a hawk, and he's willing to keep interest rates high. So he said something along those lines yesterday. At any point, no matter when this releases, he will have said something, or not reverse course. He will have said something to chasten people to make sure that people know.
Got to keep everybody guessing.
Yeah.
Got to keep everybody.
But I wonder if one of the reasons why he's saying, we're not there yet, is he imagining, well, now there's so much signs of this incredible housing demand. That means when rates start to go down, that's the first thing that's going to go up, is they're going to pour into the housing market, and home prices will go up so much.
I think that is definitely a concern, but also all markets and equities, risk assets. But I also think that there are more people who are probably, again, that's going to create less home buyers, because not that prices go up too much more. It's not like more people can afford homes, so that the buying pool continues to shrink and shrink and shrink. I also think some people have stopped looking for homes. They're like, I'm not buying a home. Yeah, at least right now. And it takes a long time for them to realize, oh, maybe I can buy a home now.
Yeah, I'm still waiting on now. Matt Vance promised this from CBRE 3 or 4 months ago, a look at the relationship between interest rates and permanent renters, or the decision on how much to buy, and how much does that factor into apartment and housing demand, the kind of intersection between the two. I think it's a very complicated issue that's hard to tease apart, and I start to confuse myself thinking of all the different factors that could come in, especially time of life stages and stuff. But it would be super interesting. I still think that the market's kind of screaming for that. It's just a look at, all right, interest rates came up this much, rent growth was this much, home prices were this much. Where are things trending? I don't think that we have a full, I don't know if we have it on our renter form or anything where tell us when you're leaving if you're going off to buy a house.
We do an exit.
Survey. Cool. So and some people do that, and I said that a week or so ago on the Gray Report. Is there for single family rentals? I guess there's some information about that, you're leaving to buy a house, and I'd love to see what the relationship is for apartment rentals.
Yeah, we'll have to see if there's a larger, broader report.
How many would-be home buyers are among the rental class?
Yeah.
Who knows?
Yeah, that renters by choice, category, which has gotten smaller, not because people are renting, just because it's no longer a choice. Yeah. It's more of a necessity, even if you're making a decent amount of money.
Exactly. Yeah.
All right, so we're gonna watch a video from our friend over at Marcus Millichap, John Chang. Always puts together these really great kind of recap videos, and the title of this is hard or soft landing, the mid-year economic outlook, and then we're going to make some commentary as this is rolling out and playing, and
the alternative title was why inflation isn't as high as people think. I like this too, because guess what we were saying last week? I think me and John Chang, we've got I think we're on the same frequency, so I think so. Let's feel pretty gratified.
I think so.
Hey everyone. As we come to the end of June and reach the midpoint of 2024, I want to take a moment to consider the economic and commercial real estate outlook for the remainder of the year.
Sounds good.
Basically, economists have defined 4 potential scenarios for the economy. One model is what's called the no landing scenario, where we continue to generate strong economic growth, but inflation also remains high. The next concept is stagflation, where the economy stalls, but inflation remains elevated. The third is the hard landing scenario, where inflation comes down, but we fall into a recession. And the fourth model is the soft landing, where inflation comes down, and although the economy cools, it doesn't go into a recession. So here's what I'm seeing in terms of the likelihood of each of these scenarios playing out. The no landing concept had some merit earlier this year when
everyone thought there was going to be a recession. It was some people were calling for 100% recession, or it was like 9 out of 10 economists all were calling for a recession beginning of this year and last year.
We saw some inflation metrics jump. The annualized 3-month core CPI reading surged to 6.6% in March, its highest reading in a year. At the same time, March job additions jumped to 310,000 positions, the most job creation we've seen since January 2023. So for a brief moment, it looked like the no landing situation was a real possibility. But the newer data shows inflation pressure has been abating. Core CPI on a trailing 3-month average came back down to 4.1% in May, and the month-to-month trend has been positive. At the same time, other economic metrics like job creation have also been tapering. So it looks like the no landing economic outlook is improbable.
Cross that one off.
Okay, no landing. It's not possible. So, okay.
Let me cross it off on my notes here.
But when I hear someone say that, I'm like, okay, no landing is actually possible. Whatever anyone says.
I'm crossing it off.
Yeah. But then that's good to
For
hear.
stagflation risk, basically none of the readings are pointing that direction. Chairman Powell probably said it best. He said, "I was around for stagflation, and it was 10% unemployment and high single-digit inflation. Right now, we have 3% economic growth, which is pretty solid, and we have inflation running under 3%. So I don't see the stag or the flation."
In my day,
you can't spell stagflation without a staggerflation.
That's true.
And because the one of the hallmarks of stagflation is high unemployment.
Yeah.
And we have like the lowest unemployment rate. So now I think the term gets conflated with just high inflation and slow growth, but it's kind of hard. That even that scenario can be a difficult.
I really think the stagflation argument started like when inflation was still high, when we just started the interest rate hikes. Then people got really scared, like if things were going to tip over.
Well, we did have a period where inflation was like 9% and GDP growth was. It's like we definitely had a period that I think qualifies as stagflation, and we're in a. It sort of feels like that in a sense, except unemployment. And I just, from my opinion, hallmark of stagflation is a very high unemployment rate with high inflation and relatively slower growth.
Now, the third scenario does have a real chance of manifesting. That would be the hard landing or a recession. I'm not saying we will have a recession or that the risk is severe, but we are walking a tightrope. If the Fed holds rates too high for too long, or if we're hit by some other unexpected economic curveball like very severe weather, a major geopolitical event, or a major supply chain disruption, then a recession is possible.
We were looking at weather futures the other day.
Oh yeah, why?
Conversations with some large apartment owners to look at weather futures. If you own properties in coastal areas, and one is insurance, and it's just one way to hedge and potentially offset some of your insurance costs. I was like, my response, I'm like, what business are we in? Are we in the real estate business? Or are we in the weather derivative hedge business?
So interesting.
Key indicators suggesting an impending economic softening include the ISM Manufacturing Index, which came in at 48.7 for May, a mildly constrictive signal. In addition, inflation-adjusted core retail sales on the annualized trailing 3-month basis has been slightly negative for the last 5 months. And unemployment has been creeping up to its current 4% rate. At the same time, both consumer confidence and consumer sentiment have been tepid at best. Not really declining per se,
Improving,
but not
tepid.
growing either.
Yeah.
So, my point here is that it wouldn't take a lot to knock the economy into recession, but it would likely require a significant negative event to tip the economy into decline. And that brings me to the fourth option, the soft landing. Basically, all the weakening economic trends that I mentioned as signs of recession risk are pretty much within the target range for a soft landing. But when you factor in some of the more positive economic growth metrics like the ISM Services Index, which was still showing a positive reading of 53.8 in May, and the fact that the US economy has added over 1.2 million jobs so far this year, then numbers suggest a soft landing remains the most likely outcome. And for commercial real estate, a soft landing is probably the most beneficial scenario.
Yeah.
The no landing outcome would likely cause interest rates to surge higher, while stagflation could be even worse because there's no known way to solve stagflation. Of course, a severe recession would also be bad as it would erode the demand drivers for all types of commercial real estate. And although the Fed would likely drop interest rates quickly if a severe recession hit, the loss of commercial real estate space demand could impair property fundamentals for a while. A mild recession, on the other hand, could affect different types of properties or different metros in different ways. But a mild recession could also bring interest rates down. And then, our baseline scenario, the soft landing, likely brings mildly positive space demand with the hope of a Fed rate cut later this year.
All right. Well, I really appreciate that. Again, that's John Chang from Marcus and Millichap with a little bit of commentary in the middle from Great Capital. So the base case is, soft landing, which we thought was a opportunity, might be hard to achieve. I think, Matt, we've gone back and forth a little bit. We've been more in like a soft landing is possible camp, I think, for quite some time.
With a similar emphasis, and really, I remember this since like October of last year. I was like, or it was like later Q4 last year, and I was like, I am, chastened about the economy. I'm not. I think that it's pretty fragile. That's when I started and it's still pretty fragile. And I think that he emphasized that correctly, is how we're not, it's no reason to be like supremely confident that things are going great, but I think that's what you need to have in order to have the behaviors that will lower inflation and to create that soft landing environment.
Yeah, I think you cannot start counting your chickens just yet. We've got a lot to work through. It's not. It's not a linear progression, and we've got a lot of stuff that could happen. Again, we've got a hurricane that's going through the Caribbean, earlier than like just about ever. We've got an election happening this year. With now talks of effects of tariffs and inflation and just
got wars.
We've got a couple. So much could happen. So much in the car, but things can happen at any point in any time, and so we can't necessarily make all our decisions based on unknown externalities. But keep an eye open.
And that's it. Just as you were talking about weather futures, but that's what's so interesting about commercial real estate and about multifamily specifically. It touches on all these different things, and they're all kind of relevant. If you have an apartment building on the shore, on a rapidly eroding shore, that suddenly becomes super relevant to know what the weather's going to be like. For this inflation thing, all this inflation data is interesting because there are multiple sources of data for inflation. There's the CPI. There's also the PCE. There you can do core inflation or fix
super core,
super core, all these different ways.
Super duper core,
and we do ultimately avidly, slice and dice all this stuff. But it is worth noting that PCE. The personal consumption expenditures, which is supposedly the Fed's preferred measure of inflation, they have come in, and we are 0.1% down from last month's year-over-year numbers. Now we're at 2.6 year-over-year numbers, which is a good deal lower than the CPI numbers that are at 3.3%. Stay tuned to next week for the release of the new CPI numbers.
Be a doozy.
I was looking at the difference between the two, and it seems that like the weights are different, the items are different, the growth in the two indices from one time period to the other are computed using substantively different formulas. That's what the White House has said in an explainer.
Isn't a component of PCE derived from CPI?
I'm not sure. I was looking.
I believe that CPI usually comes out first by the
Yeah.
time they get the PCE, and so usually by the time they're coming out with PCE,
They throw that in there.
You can pretty closely estimate what PCE will be.
Oh, okay.
If you
Yeah,
were to
yeah.
do CPI.
It does. There's an explainer from the White House that they released in like September or so last year that looks at how much of a difference, whether it's weight, scope, formula, or this other category, has determined the difference. And they were like, all right, this is why the weight difference means that it drugged the CPI down a little bit or not. And
Yeah.
that was kind of interesting, but it was a little, it's a little shaky.
So, politics corner, just for a second, Matt, did you watch the presidential debate last Thursday?
Yes, I did.
Did you catch Biden's comment on rents?
No, I didn't. What did he say?
He was talking about inflation and he was talking about the housing crisis just a little bit, and he said we're going to cap rents.
Oh, I didn't.
He threw out this idea of capping rents. Now I think it was just a blurt of
He also said he was going to beat Medicare.
and he also said that no service members
what does it
died.
mean to beat Medicare? And they cut him off right after that.
I don't think we don't need to beat him up on too much.
All right,
I don't think he's going anywhere. And again, I don't put too much weight behind the comment on capping rents, other than that it was a thought in his mind that he threw out there. And I think that it's a talking point that resonates with Democratic voters about some sort of rent controls and the rent's too damn high and again eat the rich and et cetera. But in practice, it's very impractical if not unconstitutional to have some sort of like national rent cap. The only mechanism that I could see is through FHA finance properties, which would include Fannie Mae, Freddie Mac, HUD, which do finance 50% or so of multifamily mortgages. If they wanted to put some requirement through there, if I was someone who was trying to put rent control in place, that's a way you could do it, maybe. But even I don't know if their mandates would even allow for that. But you can't. I mean, it's a local issue. Rent control is like a local issue. Very rarely is it even a state issue. It's municipalities.
Liberal municipality of Minneapolis. They have lower rent. They had lower rent growth because they had programs that built a lot of apartments.
Yeah.
Now I wonder too if there was if there was also some regulatory burdens associated with building in Minneapolis, but still they did have lower rent growth and they did build more. And there were some articles about that in like 2022 and in 2023 a little bit.
The only way the solution is more supply.
The solution
is more supply, and they all know that.
The White House has written that
exactly, and that's exactly a great point, because what they actually write when they put some actual thought behind it, as opposed to just blurting out some things on the debate stage. It wasn't a great night. Not surprising. So I don't put too much weight on it, other than again it's just in the lexicon that it just needs to get fleshed out. As it's like not only is it you're not able to do it at a national level, it's unconstitutional, but it's also it's just bad policy in the sense that it does not achieve the objectives that it's intended to achieve, and in fact can have the opposite effect of actually increasing the cost of housing over time and decreasing the quality of housing.
Or in New York, what happens is the older you are, the more likely you're gonna have rent control, and it's mildly correlated with there's a bunch of rich people in these places with rent control. It's how it settles out. So it's not you can't really exactly have an equitable distribution of the rent control units. It's just a whole can of worms that you can solve easily.
It makes people feel good. It makes people. It's the idea.
And I am not even if I can imagine a hypothetical situation like you were kind of mentioned too, where maybe rent control can work in this certain way, but as a band-aid solution, as a guiding dominant force, no. You can plug it into the existing affordable housing programs, great, but as a fiat that applies to every single market rate house, or
talk about exacerbating the housing crisis. That's what would happen. All right, Matt. I highly recommend, if you enjoyed this episode, if you're watching on YouTube, make sure that you like this video. Leave a comment if you have any thoughts, but make sure you give us a subscribe. That way you can be notified, especially if you hit that little bell icon. That way you're going to get updated with all the new releases from Gray Capital, episodes of the Gray Report, as well as episodes of The Complex that focuses much more on property operations and property management. It's hosted by Katrina Green, our Director of Property Management here at Gray Residential, which is the property management arm of Gray Capital. Thank you for sticking around for this episode. And again, if you're an accredited investor, hop on over to solanaindy.com. That's the latest and newest investment opportunity from Gray Capital. It's an incredible 384 unit A-class property in Indianapolis. If you think of what we said today makes sense, that thesis and that outlook, that's basically what we're doing. We're buying a high quality property at a big discount, suppressed price, but way below replacement cost, and we're going to take advantage of the growth over the next 4 to 7 years. So if you want to hop in that deal with us, we've got a little bit of space. We're like, honestly, we by the time this episode airs, we will probably be oversubscribed. So if you hear this now, just check in with us, see if there's any more room. If not, catch us on the next one. But we're really excited about it. We're gonna be closing soon. All right, thanks again, Matt. Any other closing remarks?
No, I'm just in a good mood today, and I think everyone should be.
Good. I saw this video. I've been watching these videos of Gen Zers talking to their manager.
Oh, yeah?
Not to extend the episode.
Yeah.
But this one girl, she called in. She's like, "Hey, checking in. I'm in such a good mood today.
Yeah.
I have energy. Like I'm just." And the manager's like, "That's awesome. That's great to hear." And then the Gen Z, the employee's like, "Yeah." And so like I'm gonna have to call out from work today because I just don't want to waste all of this positivity on like a work day.
Oh man,
it's like, what are you? Anyway, so
that's great. I like that.
All right, catch you on the next episode of the Gray Report. And again, solanaindy.com if you're a accredited investor. Catch you next week.